Hello and welcome everyone again to another financial analysis video with myself, Moeed Amin, and Ted Wayman. So in this show, we help you improve your financial acumen and understanding by analyzing the financial statements of famous companies. And most of these companies that we analyze, probably more than 95% of them, come from requests from you, the viewers. So if you have a company that you're interested in, whether you are selling to them or they're a client of yours, whether you're thinking about investing in the company, or even if you're applying to join them and you want to have something smart to say in the interview process, do leave a note in the comment section with your request and put some kind of context behind that. The more interesting the context, the higher up the priority you will go. So company today that we're going to be analyzing is AO World. Now, AO World are a retail group in the UK, and they kind of focus on electrical and domestic appliances. So they deliver their goods through their own kind of in-house logistics process, but they also have selected third parties as well. And also worth noting that they provide ancillary services. So they don't just sell the products, they will do collections of old products. So they'll kind of give you the new product and take out the old one for you. They will do what's called product protection plans, so extended warranties, things like that. So they do cover a few other services about the business around the products as well. So a few things to note about the company as context before we dive into the financials and also the share price as well. So stick around for that. So they are a penny share stock. And to be honest, the share price has pretty much declined a huge amount since around February 2021. So stick around. We're going to look into that in a bit more detail. The other thing is that they recently raised funding of £37.3 million, both with institutional investors and public investors as well. And this is basically because of a restructure that they're going through. They're also shutting down the German business as well. We're going to go into that in more detail and help you kind of identify those things if you look at other financial statements as well. And the forecast, or at least the plan, is that they're trying to save £25 million by 2025. Now, the situation with AO World, just to give you some context, is they're shifting away from growth and what we're hearing with companies, growth at all costs, and they're moving more towards profitability. This is not new information. A lot of companies are going through this now, particularly with the kind of recession fears and private investors kind of placing pressure on businesses to extend their runway, which basically means extend the amount of money you have and your cash available so that you can protect the business. So we're going to look into that. One of the newest non-executive directors is a gentleman called Chris Hopkinson, and he was the CEO of another well-known retail company in the UK called Pets at Home. Now he bought, and this is really interesting, he bought 2 million shares of the business at a price of 43 pence per share, which is about a 38% discount of the price of the share price at the time. And that's consequently why he became a non-executive director. But he has a lot of experience in the retail industry. So he may have quite a bit of valuable insight and inputs to give to the business that would help them in their growth and in their profitability kind of plan. So just some information there as context. We're not going to go into too much detail about those things. We're interested in helping you just look at the financial statements, and we'll analyze those financial statements for you. Quick note on the share price, right, as context, but stick around because we're going to talk about that in more detail. So as I mentioned, they've gone through a bit of a decline. They floated in 2014. If you'd invested back then, you'd be sitting on a loss of about 88%. If you'd invested 5 years ago, you'd be sitting on a loss of 62%. And if you'd invested just 1 year ago, you'd be sitting on a loss of 81%. So it has gone through some fluctuations, and you're going to see that towards the end of this session. So let's fire it over, Ted, and share with our viewers what we found about this company and kind of run the analysis with them as well.
Good to see you, Moeed, and good to see all of our viewers again. Welcome back to our subscribers. Welcome to our new joiners. So if you've never seen any of these videos before, then welcome. Please do remember to subscribe, like, and share. As Moeed mentioned, most of our videos are based on recommendations by people who are watching the channel, and this is no exception. So here is Matt. Matt, you've asked, can you do AO World? AO World, a nice picture of Matt and his couple of kids. Can you do AO World or Lookers, please? And we're going to be looking at AO World. AO appliances online. So just so we're absolutely clear, we're talking about fridges, freezers, ovens, microwaves, and kind of dishwashers and all that kind of stuff. So the kind of the big white label goods. Okay, so let's jump into the accounts. So these accounts, very easy to find. They're online. Here they are. So you can just Google for AO World annual report and accounts. You've got the 2021 accounts. We're now at the end of September 2022, so we're not going to be seeing any 22 accounts for a while. And once again, lots of pretty pictures, lots of information to tell you all about the company, who they are, what they do, who's on the board, what their strategy is. So Moe mentioning a change in strategy, their corporate governance, who's joined the board recently, and their kind of their pedigree, so to speak, etc., etc., etc. But we are going to whiz all the way through this and get stuck into the numbers. So here we go. We are on page 157. Takes you 100 page to. It takes until page 157 in order to get down to the actual numbers. And here they are. So we are looking at 2021, which is highlighted for you in green there. And you'll see it says in pounds millions. So the revenue, the total revenue is about 1.7 billion pounds. Okay, so that gives us an idea of the size of the company. Very interesting, substantial increase on the prior year. So 2020, don't forget, 2020 was kind of the lockdown, and you kind of felt that people, online retailers were benefiting in lockdown, perhaps though people were feeling a little bit nervous about the future and maybe weren't spending it on fridges and freezers, but more on sort of takeouts, for example. So anyway, so since 2020, big bounce back, big increase, 60% increase in sales, and 60% increase in sales means that we see a 60% increase in the cost of sales. So while their gross profit has increased substantially, the gross margin remains at about 16 to 17%. So 17% 2020, 16% in 2021, which basically means every time you buy a fridge from these guys, and if you pay, let's say for sake of argument, you pay £1,000 for a fridge, they will have paid £820 from the manufacturer. So that kind of gives you an idea of the kind of, the margins that they're making. So it's not a very big margin. And their aim is to say, look, we can do it cheaper online because we don't have to pay for the bricks and mortars and all the staff and the kind of the rent and the rates for those actual physical places like PC World or Currys, where you can go and buy, or John Lewis, who we looked at I think last week, who also you can buy these goods from. So all well and good. However, not so good is this number here. So here we have the cost of running the business. Now the cost of running the business in the prior year meant that they actually ended up making a loss. In this year, it's still a very big number. So yes, they are making a profit, but it's nothing really to write home about. That's a 30 million profit on a operating profit on a 1.7 billion turnover, which basically says they're running at pretty much break even. Not a lot of room for error. So Moe's comment that they're trying to take 25 million out of the costs, out of the overheads. That's trying to reduce this figure here by 25 million, which should see this figure here go up by 25 million. So from 30 to 40, 50, 55 million. Even so, it's still very, very, very tight margin business. Okay, there's really not a lot of profit in that. Down the bottom, a little bit of other income, probably from money sitting on deposit. Here's their finance costs. So a little bit of debt suggesting there, or some kind of leases, and that brings us down to the profit for the year. There's no tax, or very little tax, because they're really kind of operating at almost break even. So very, very little tax, and therefore they are making that they're making that profit, so to speak. Yeah, 17 million pounds of profit on 1.7 billion of turnover. They're operating at break even. It's a really tight business, and they're obviously trying to kind of consolidate, reduce the costs associated with trying to expand overseas or into new markets, etc., and really try and grow that bottom line margin. It's not going to grow hugely because that's how they set out their store. They're aiming to undercut the kind of the bricks and mortar, the high street, so to speak. Let's go and have a look at the balance sheet. Balance sheet. So we have here the non-current assets. So these are what we need to run the business. Quite interesting. Sitting on their balance sheet, their biggest number is this number here, which is the trade and other receivables. Now, this trade and other receivables suggests that they are financing the sale of some of these products. So if you take the trade and other receivables, you generally expect them to be here in the current assets. So just to remind ourselves, the current assets, things that we own that are expecting to become cash or already are cash, which is inventory, trade receivables, and cash at the bank. Non-current assets, things that we need to run the business, like tables and chairs, plant machinery, and equipment, which is obviously in here, which is a reasonable size. And plus, these are also property, plant, and equipment, but they're known as writers' use assets, which basically means they're on hire purchase. So either if they bought a photocopier, it's going to be in here, and if they've kind of rented a photocopier, it's sitting in here. So those are the kind of, that's what they need to run the business. They got a little bit of goodwill, and we've talked about goodwill before. It arises on acquisition of other companies. But this trade and other receivables suggests to me that they are financing. So they're effectively saying you can buy a fridge from us, and we will let you pay over a period of time. And that period of time will mean that they will then earn additional interest on that sale. They'll charge a rate of interest for it, kind of the buy now pay later. So those are the assets. Total assets are 615 million pounds. A little bit further down we can see the liabilities. We'll just come down to about here. So here's the liabilities. Current liabilities, 432 million. Now this is our first warning sign, because a kind of very standard liquidity measure is to compare current assets to current liabilities. So if you have current assets of 374 million pounds and your current liabilities are 432 million pounds, to kind of translate that into English, basically what it says is for every £1 you owe and have to pay soon, you've only got 86p either as cash or coming in as cash soon. Okay, so that's an alarm bell. If we want to look at it on an acid basis, or the acid test, the quick ratio, we eliminate inventory. Sorry, I'm pointing at the wrong bit here. We eliminate inventory, okay, which is up here, and the inventory, the reason we do that is that the inventory is the least liquid of your non-liquid of your liquid assets. So for example, if you are a supplier to these guys, so if you are sitting in here, if you've supplied them with goods and services and you're waiting for your invoice to be paid, they might say, look, we've got 67 million in cash, and you're thinking, well, you owe me 411 million, you can't afford to pay it. They say, well, we've got some trade and other receivables, people who are going to pay us because they bought the fridge, they're going to pay us, and when they pay us, we'll pay you. And you're like, okay, at least the contract is dry. But if they're saying, look, we've actually got to sell these fridges, you're kind of thinking, well, let's hope that we don't have a cost of living crisis. Maybe that's a little bit of a facetious comment at this point, but people are starting to see energy bills go up. They're looking at mortgage payments are going to be going up as interest rates rise into the future, which means that there's going to be less money to spend on fridges and freezers, moving house, buying new dishwashers, etc., etc. Maybe I'll stick with the existing one. So again, we can sort of, we do need to sort of bring in this number up here and say, look, don't forget that these guys who owe more than a year, ultimately that's going to fall down into here. So there is a kind of a pipeline of cash coming in longer term, but even so, that is a little bit kind of, that's an alarm bell. And if we look at the acid test, it says it's 0.54, which basically says for every £1 this company owes to its suppliers and has to pay within 12 months, it has 54p, ignoring the inventory, either as cash or coming in as cash within the next 12 months. So this is a problem for these guys. Now, if we go and look at the auditor's report, which I have to admit we did kind of, we did gloss over, but it's always worth looking at the auditor's report. In the auditor's report, there is a note on going concern. Now, just so we remember, going concern, if you describe a company as a going concern, that is a good thing, because it means that it is trading and expected to continue to trade for the foreseeable future. If it is no longer a going concern, then effectively it is closing. It is either going into administration or it is going into liquidation. Either way, that is a problem. So if you buy a warranty from a company and the company goes bust, your warranty is effectively worthless. Okay, worth bearing that in mind. So this is actually relevant to the customers of companies like AOL. So the auditors say, look, they basically say, look, we've looked at these accounts and we recognize that there are risks out there. We understand that there are risks, and there's a possibility that for any company that is going to get into financial problems and go down the plug hole, so to speak. But they said, look, we've looked at the going concern disclosure in note 3 by the directors, and we believe that it does not appear unreasonable for this company to still be a going concern, i.e. to say it's still going to be trading. Okay, kind of double negative in there, covering themselves. So it's worth just having a little look at note 3 to see what the directors have actually got to say about this. Now, this is actually, now they mention it, they do mention it in their director's report, but the director's report is not specifically covered by the auditors, whereas the notes to the accounts are specifically covered by the auditors, and therefore we actually want to have a look at it. It's on page 662. Let me just pull that up. So here we go. So they recognize they've got these net liabilities, that the assets, the current assets, are less than the current liabilities to the tune of 60 million. And they say, look, we've got, we understand this. We've got availability of a revolving credit facility that we can draw down on, so we can kind of tap up the bank. And we are pretty confident. We've done our cash flow statements, so we are pretty confident that we are a going concern and that we can continue to trade. It would be illegal for the directors to continue to trade if they were no longer a going concern. So these guys, it's a bit like, they're not teetering on the edge, but they're wandering around close to the cliff edge. And we just want to be aware that, that cliff edge exists, so to speak. We did a little bit of analysis on working capital requirement, and I'll just read this out to you. So their inventory days, it takes them about 28 days to sell their inventory. They get paid relatively quickly. Obviously there's that the long-term liability as well, so some of that sort of long-term financing, but as a general rule they're getting paid pretty quickly, but they are spending 53 days to on their accounts payable. So it looks to me like if you're a supplier to these guys, they're going to be pushing you to finance their business. So they are pushing back pretty strongly in order to fund their business. So just to be aware for a supplier that they're going to have some pretty hard negotiations on their payment terms, and they're not necessarily going to pay on the terms that they agree. Now, I may be wrong on that, and if you're a supplier and you have a different experience, then please do let me know. Anyway, so there's our balance sheet, and we come down to, so the balance sheet, we've got equity. They do have equity in there, 96 million, so they've got a positive balance sheet. Mary, you mentioned that they've done a fundraising that isn't reflected in these accounts, so that fundraising will have happened in 2022, and we can see that because there's been really no change in these numbers here. So we'll expect to see that when we do the analysis in the next if we do look at these guys again in 2022, we will see that sort of that cash injection. So, you know, these are just to remind ourselves, this is very much a backward looking a set of accounts. This is tell us what's happened in the past. And then when we talk about the share price, we're looking at, you know, sort of the market anticipation of what's going to happen in the future. So there's our balance sheet. Nothing really to say in terms of movement in equity. They're not paying any dividends. They can't afford it. They're going to keep all the money in the company. So we'll kind of, you know, we'll gloss over that. And here's our cash flow. Now, pretty important on the cash flow. So the first thing to notice, so what we're really interested in here on the cash flow to begin with is the cash from operating activity. So that's their cash equivalent of the operating profit. Now they split this between two different types of cash profit. One, which is the cash flow from the operating activities, and two is the cash flow from movement in working capital. Now, movement in working capital is basically looking at inventories, payables, and receivables. So if you buy more inventory, you will have less cash. Their inventory has gone up by 6 million, and therefore they have less cash. If you pay your supply, so if you don't collect from your customers, you'll also have less cash. And what we see here, therefore, is that they are funding a lot of their business through this increase in trade and other payables, which is in effect the increase in the cost of, sorry, not the cost, the increase in the amount that they are owing to their suppliers. So these guys look like they're using their suppliers in order to fund the business. Now, if that was zero, if they did nothing, if they carried on paying the suppliers at exactly, then they'd end up with a negative cash flow. Okay, so again, that's an alarm. You can't use your suppliers to fund your business forever. At some point, you're going to have to pay your bills. There's another little bit of an alarm bell going on there within the cash flow. As for the rest of the cash flow, very little investing going on because they really, they just haven't got the cash. They're trying to preserve cash, so they're really trying to kind of consolidate rather than trying to grow their business. And in terms of the financing, we can see that they've repaid their borrowings. They've gone debt free. There's no debt anymore. They just we just got to get out of borrowings. They are paying some leases, and that's basically it. So there is some negative cash flow from their financing activity. So the net effect is that they ended up with more cash than they started, and they built the business from 7 million in the bank to about 67 million in the bank. So the bank balance is going in the right direction, although 7 million left in the bank at the end of last year. Basically, they're building it from a very, very low base. So these guys, it looks to me like they're trying to turn a corner. They're trying to just consolidate. They're trying to sort of sort it all out, so to speak. I forget the exact history of this company, but it was launched based on a bet. Somebody, I forget the guy's name, but he bet his friend that he could launch it. His friend said no, you can't. So he did it to prove him wrong, and here it is, and it's 1.7 billion of turnover. It's trading pretty successfully. However, it has some financial pains going on at the back end, and this is the kind of this change in the strategy, the consolidation that you mentioned, Moeed, is all about trying to sort that out. So let's have a look at the share price. This is what it looks like. So as Moeed said, it's been a pretty rocky ride, and it has plummeted all the way down to the bottom. Quite interesting here that here's our pandemic arriving and everyone going, oh, it's an online stock. Everyone's going online, it's going to make an absolute fortune, and then since then it has been sort of all the way down. And mentioning this penny stock, just the fact that it's very, very low, in fact it's the lowest it's ever been, doesn't mean it can't carry on going down to zero. Okay, so whatever you pay for a share, it is still possible to lose 100% of your investment. So these guys, in terms of their market cap, their valuation, they're making a 17 million turnover, 17 million profit. You're paying basically 250 million is the market valuation. That's about 15 times earnings. It's not cheap, it's not expensive, but it's not cheap. So that's a kind of a 7% yield on their earnings. You're not getting any income from that. These guys, they do have cash flow issues, which is causing them a little bit of a problem. So I think that these guys are higher risk than most companies. I think that they will continue to find that they are high risk. I think that people will pull back on some of these bigger purchases as they have to pay for increased energy costs. They got a balance sheet of about 100 million. So there's about 150 million of goodwill kind of baked into that price. We talk about investing in these guys, and obviously, if you're a long investor, you're betting that the share price is going to go from here, it's going to go up. And if you're a short investor, you're going to be betting that it's going to be going down. And I'm not absolutely certain. I think that they have some problems. I think it's baked into the price. If you feel that this is it, they've hit the nadir, there's a turning point, then by all means gain some exposure, but realize that it could go down. And if you think no, actually these guys, there's the recession coming, these guys are just going to fall over, there's no way they can survive, they haven't got the sort of the financial resources sitting behind them, then you might want to short them and suggest that they are going to go down the Swanee. But that's kind of I'm neither long or short, Moe, let's put it like that. There you have my my kind of take on AOL. Is it a good investment? I don't know. It's not for the faint-hearted. It's quite an interesting company. Honestly, I think I've bought stuff from AOL. I can't remember. I'm pretty sure I bought a fridge from them, and it turned up on time, and we had two perfectly nice guys who came in and they put it in and they took the old fridge away, and it was brilliant, and the whole thing worked. So so why not, so to speak. Yeah, sometimes people want to they just like to kind of physically hold and touch that product. And of course we did a bit of research. We went to places like Curry's and looked at fridges before actually buying online. So that desire to actually hold stuff I think is still there. But we are being more comfortable buying fridges online, buying cars online, and having them delivered. So there you go, Moe. There's my take on AOL, not without its financial challenges.
Yeah, and just a note, Ted mentioned AOL a few times there. It's actually AO World,
not AOL.
Yeah, AO World, but it's so similar. It's so similar in sounds. But yeah, that's the analysis there. So this is not financial advice. This is not even about investing, although we talk about the share price because it's important to look at that as part of the context. But remember, the purpose for these videos is to help you improve your financial knowledge and acumen by being able to read financial statements more accurately. And we look at famous companies as good examples of that. So do leave a note in the comments section. Tell us how you found this video, how helpful you found it. If you have any companies you would love for us to analyze, then do leave a note in the comments section. And as always, like, share, subscribe. We will both see you on the next video. Thank you.
Good to see you, Moe. Catch you later.